What if the single biggest financial mistake is disguised as a prestigious decision? What if the path to success is actually a trap? We are taught that education is the ultimate key, but is this belief truly serving us in today's economy? We need to talk about $100,000. For many, this sum represents a life-changing amount of money. Countless people hand this amount over to universities, believing they are buying a ticket to the top. The real return on that investment is rarely discussed with complete honesty. What if that sum was put to work for you? This is the question that institutions don't want you to ask. This is a cold, hard, financial showdown. We are going to put a DBA program head-to-head against income-producing real estate. Which path truly leads to greater wealth over the next 5, 10, or 20 years? The answer might surprise you. Let's compare traditional education, like a doctorate of business administration, with real estate investment. A DBA involves years of tuition, living expenses, and lost income. The opportunity cost alone can be hundreds of thousands of dollars. Now, consider investing that same amount in Midwest real estate, known for affordability. Instead of tuition, it becomes a down payment on multiple income-producing properties. This provides immediate cash flow, property appreciation, and tax advantages, building equity from day one. Universities advertise tuition, but that's just the beginning. A DBA can range from $20,000 to over $50,000 per year. Programs typically span 3 to 4 years, totaling $60,000 to $200,000. Let's use a conservative $100,000 for tuition. But that's just the tip of the iceberg. Living expenses add up. Rent, groceries, and utilities continue. At $2,000 per month, that's $72,000 over 3 years. Our $100,000 education now costs $172,000. Don't forget textbooks and fees. The total investment creeps up, often doubling the initial tuition figure. The real cost is much scarier, a number that might make you think twice. Now we need to discuss the single biggest and most ignored expense of pursuing a DBA, the opportunity cost of your time. If you're qualified for a DBA program, you likely earn a decent salary, earning say $80,000 per year. A 3-year program means giving up $240,000 in earnings. Adding this to direct costs, the true cost explodes to $417,000. You're sacrificing present earnings for potentially higher future earnings. Even part-time programs trade your time and energy. Opportunity cost separates a savvy investor from a consumer. The true cost is the wealth you fail to build during those crucial years. Beyond obvious costs, there's a hidden financial drain: funding. The solution is often student loans, escalating costs further. You're paying to borrow, interest accumulates, adding thousands to your bill before graduation. Debt grows silently. You emerge with debt, starting from a deficit. Years are spent getting back to zero. There's a psychological cost, dictating career choices and delaying life milestones. Freedom is overshadowed by loan payments. There are no guarantees. You bear all the financial risk. The university keeps your money, you're left with debt. This is the transfer of risk to the student. Let's take a different approach. Investing $100,000 not in tuition but in real estate. Instead of buying one expensive property, you target the Midwest, where homes are affordable and rental demand is strong. With $100,000, you can make 25% down payments on $400,000 worth of properties, acquiring 3 or 4 rentals, not just one. This is the power of leverage. Your money controls assets 4 times its size. Unlike a degree, your capital isn't spent, it's working for you, building wealth. You benefit from appreciation on the full $400,000, not just your initial investment. If one property is vacant, the others still generate income, diversifying your risk. You're not just a student, you're an owner, building a portfolio and a balance sheet. This is the dramatic advantage of real estate over the traditional education path. You start building wealth from day one. Real estate builds wealth in 3 ways: cash flow, loan paydown, and appreciation. First, cash flow. Rent covers expenses, leaving you with real spendable profit each month. Second, loan amortization. Tenants pay down your mortgage, growing your equity automatically. Third, appreciation. Even modest growth increases your portfolio's value by thousands each year. Add it up. Cash flow, loan paydown, and appreciation can yield a 29% return on your $100,000 in the first year. Plus, real estate offers major tax benefits. You can deduct expenses, mortgage interest, and depreciation. Often your rental income is largely tax-free, something a high-salary DBA grad can't match. Your wealth grows on multiple fronts, not just from a paycheck. This is how real estate multiplies your money. It's a wealth engine, not just a job. Real estate gives you control. You're the CEO, not dependent on employers or the job market. You choose properties, tenants, and strategy. If something isn't working, you can fix it or pivot. As your properties appreciate and loans are paid down, you can refinance and buy more, scaling your portfolio exponentially. Passive income grows. $12,000 a year becomes $25,000, then $50,000 as you reinvest. Eventually, your cash flow covers your living expenses. You reach true financial independence. Contrast this with a DBA higher salary but still trading time for money. Stop working and the income stops. Real estate builds a machine that works for you 24/7. It's not just a financial strategy, it's a path to freedom. You're building a key to escape the rat race, not just a bigger cage. 5 years later, let's compare our DBA grad and real estate investor. The DBA earns $130,000 a year, but after taxes, loan payments, and living expenses, saves about $25,000 a year. Their main asset is their ability to earn a salary, but they're still paying off $175,000 in student loans. The real estate investor's portfolio has appreciated, and the loans have been paid down by tenants. Their properties are now worth $463,700, with equity growing from appreciation and loan paydown. Cash flow has increased to over $13,000 a year, passive and largely tax-free. The investor's wealth comes from assets, not just income. The DBA is a high-paid employee, the investor is an owner with a self-sustaining financial engine. One relies on a paycheck, the other on a growing portfolio. That's the real difference after 5 years. Now let's look at net worth, the true measure of wealth. The DBA grad after 5 years has about $50,000 in savings but still owes $175,000 in student loans, net worth, negative $125,000. Despite a high salary, they're still digging out of debt. The real estate investor's properties are worth $463,700, with $272,000 left on the mortgage. Their net worth, $191,700, plus $30,000 in saved cash flow, over $221,000 total. The difference? A staggering $346,700 in favor of the investor. One path trades capital for a future paycheck and debt. The other builds assets and equity from day one. The numbers don't lie. In 5 years, real estate isn't just ahead, it's a total knockout. That's the power of building assets, not just chasing income. Beyond the hard numbers, we must evaluate the less tangible factors of risk, liquidity, and control. The DBA path is often sold as the safer, more secure option, but honestly, this is a dangerous misconception. The DBA graduate has concentrated all of their risk into a single asset, their ability to command a high salary in a specific field. If their industry is disrupted by technology, if a recession leads to layoffs, or if they suffer a health issue, their income stream just evaporates. Their degree is completely illiquid. They can't sell a portion of their PhD to pay the bills. They have zero control over macroeconomic trends or corporate decision-making. The real estate investor, by contrast, has a diversified and more resilient risk profile. Their risk is spread across 4 separate properties and 4 separate tenants. If one tenant loses their job and can't pay rent, the investor still has income from the other 3 properties. If the housing market in one neighborhood stagnates, another may be booming. The assets themselves, physical properties, have intrinsic value and are far less volatile. This diversification provides a significant buffer, creating a much more stable financial foundation. The risk is managed, not concentrated. Now consider liquidity and control. If the DBA graduate needs a large sum of cash, their options are limited. They can try to get a personal loan, but they cannot easily tap into the value of their education. The real estate investor, however, has multiple levers to pull. They can sell one of their 4 properties to generate a large cash windfall. Or, more strategically, they can do a cash-out refinance, pulling equity out without selling the assets. This gives them access to tax-free capital for more investments, a business venture, or a personal emergency. They are in complete control of their balance sheet. This element of control is perhaps the most underrated advantage. The investor is the active pilot of their financial destiny. They can choose to be aggressive and scale quickly, or be conservative and focus on paying down debt. They can hire a property manager for passive income, or manage it themselves to maximize cash flow. The DBA graduate has essentially outsourced control to an employer. They can influence their career path, but they can't control the company's decisions. In the real world, control is the ultimate form of security. A $100,000 education is largely an American problem. The US has one of the most expensive higher education systems. Many European nations offer world-class education for free or at a fraction of the cost. Taking on six-figure debt is often seen as financial insanity. What are you paying for with that American premium? That same capital could build a business back home. This exposes the provincial nature of the traditional American dream. They get the knowledge without the debt. It is frequently seen as a very expensive ticket to gain access to the US job market and immigration. Savvy investors use alternative strategies that blend education and wealth building more effectively than the siloed American approach. One strategy is to prioritize cash-flowing assets first. An investor in a volatile economy understands that a stable, passive income stream is the ultimate security. Another powerful international strategy is geo-arbitrage. A professional might earn income in a strong currency through remote work, but reside in a country with a lower cost of living. This widens the gap between income and expenses, allowing them to save and invest more. They can then deploy this capital into investments anywhere in the world, building wealth faster. They view the entire globe as their playing field. This global perspective provides the ultimate lesson. The path to wealth is about having options and maintaining control. This flexible, global mindset is the ultimate tool for building a life of true wealth and freedom. Now we arrive at the most uncomfortable part of the discussion. Is there an ethical component to this choice? Society tells us becoming a highly educated expert is a noble pursuit, implying contribution to society. Real estate investing is often painted with a more cynical brush. Critics argue you're profiting from a basic human need. This narrative pits the noble scholar against the greedy landlord. But let's challenge this narrative. Is the university system truly benevolent? They charge exorbitant tuition, creating a system of indentured servitude for their students. Is it more ethical to give money to a massive university or provide housing for families? The lines are not as clear as they seem. The real estate investor provides immediate tangible value. We've looked at the numbers, compared net worth, and examined risks. Now, which path is the smarter investment for building wealth? Is it the doctorate, with its promise of a high salary but massive debt? Or the entrepreneurial path of real estate, with passive income and control? What do the numbers tell you? What was the most shocking data point? I want to see a real debate in the comments, backed by data. This is a statement about what you value most. There's a right answer for you. Before you sign up for that expensive degree, run the numbers. The choice is yours. Throughout this financial showdown, we've replaced conventional wisdom with cold, hard numbers, comparing the cost of a DBA against a real estate investment. The data has painted a picture that is quite shocking. The traditional path revealed itself to be a financial minefield. The pursuit of the DBA tallied up to a true cost approaching $500,000. By using their capital to acquire income-producing assets, they initiated a powerful cycle of wealth creation. The verdict delivered by the numbers is unambiguous and stark. Real estate investment dramatically outperformed the advanced degree. Building a strong balance sheet of assets is a far more robust strategy than simply pursuing a higher salary. This analysis is not an argument against education itself. Knowledge is invaluable, and the pursuit of learning is a noble endeavor. However, this is a direct and uncompromising challenge to the business of higher education. It is a system that has successfully marketed expensive degrees as the only legitimate path to success, while obscuring the devastating financial trade-offs involved. The conclusion we must draw is that you should never blindly outsource your financial future to an institution that has no vested interest in your personal net worth, only in your tuition payments. The ultimate takeaway from this comparison is a call to action for financial self-reliance. It is an appeal to question the traditional life script. Before making any six-figure investment, whether in a degree, a business, or an asset, you must become the chief financial officer of your own life. You must be willing to do the hard work of running the numbers, of calculating the opportunity costs, and of creating alternative scenarios. Do not accept the glossy brochures and the alumni success stories as proof. Your financial model, your spreadsheet, is the only source of truth you can truly rely upon. This means you must separate the act of learning from the act of purchasing a credential. In the internet age, you can acquire world-class knowledge for a tiny fraction of the cost of a formal degree. You can learn about business by starting one. You can learn about real estate by analyzing deals and talking to other investors. If you decide that a formal degree is still the right path, you must do so with your eyes wide open, fully aware of the financial hole you are digging, and with a concrete, realistic plan to get out of it. Ultimately, the choice between a $100,000 education and a $100,000 investment in real estate is a choice between two different philosophies of life. One path prioritizes status, credentials, and the hope of a higher position within a pre-existing system. The other prioritizes ownership, control, and the construction of an independent financial foundation. The data strongly suggests that the path of the owner, not the highly paid employee, is the more certain route to wealth. Before you make a decision that will shape the next decade of your life, take a step back, look at the raw data and decide which future you are truly trying to build.